Good afternoon and welcome to the St. Mary's County 457B Governance Committee meeting this Thursday, June 26, 2025. I apologize for being 7 minutes late. Not I, but the meeting. I was here. But, we will start as we always do, to my left, with introductions.
Catherine Pratson, Director of Human Resources and Plan Administrator.
Vanetta Van Cleve, Chief Financial Officer for the county.
Tracy McPherson, Deputy Director of HR, Employee Member.
Chris Caslemas, Director of Economic Development.
Dylan Payne, Program Manager, DPW&T, Employee Member.
Heather Schrader, Benefits Administrator and Recorder.
Thank you. And can I get an approval of today's agenda?
I move to approve the meeting agenda.
Second.
I have a first and a second. All those in favor signify by saying aye.
Aye.
Aye. Ayes have it, motion carries. Now what about the approval of February 27th, 2025 meeting minutes? Do we have any additions, deletions, corrections? If not, I will entertain a motion.
So moved.
Second.
I have a first and a second. All those in favor of the motion, please say aye.
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 Ayes have it, motion carries. Before we roll into new business, we must, as always, recognize a departing member. Christopher Casalemas is getting off the board. And so the Commissioners of St. Mary's County officially commends Christopher Casalemas for his outstanding, praiseworthy, and dedicated service on the 457B Governance Committee. We hereby express our sincere gratitude for your service, extend best wishes for your future endeavors, and ask God's blessing upon you.
Thank you very much.
Words of wisdom for how we should be investing?
No, keep it going. Things seem to be going well.
Thank you, sir.
Yeah.
Thank you, Chris.
And thank you for all you've done
Yeah,
for
thank
the
you.
board. You were part of the, what did we call them, since we're down here in Navy land? A plank owner, right? One of the initial founders of this meeting.
That's true.
And now, going to new business, we will do the Voya First Quarter 2025 Plan Summary. Sarla Kata, Voya Retirement Services. Welcome.
Thank you. Let's see, I'll just skip to the next slide, provided I can figure out how to work this.
Is it turned on the side?
It looks like it is. Yeah.
Probably the last person broke it.
Couldn't be me. Are you able to advance it for me, or would you?
No, I can't even do it.
It's on. Okay. Thank you for vouching for me.
And you can't advance it either, Heather?
No, I can't even get out of it.
Andrew will come out.
Yeah, Andrew, we need some technical help. Please. All right. Try your.
Perfect.
Perfect.
Thank you.
Thank you, Andrew.
All right, we'll go to slide 3. First of all, thank you, and I hope you all are doing well. Appreciate the opportunity to provide you with an update. I did change the format slightly. The first column, I have Q1 2025, and then middle, Q1 2024, and then I also included the numbers for 2024, the calendar year. So that way, as we continue to meet, you'll be able to see how we're progressing towards, in comparison to last year, as well as giving you that quarter by quarter comparison. So looking at Q1 2025, you'll see the beginning balance of 23.7 million. We had 436,000 deposited through payroll contributions, which was an increase of about 17.37% compared to same time frame 1 year ago. When we break down those contributions, 90% are being saved on a pre-tax basis, and then the rest in the Roth after tax. And speaking with Marta, it's the younger individuals that are looking to save money utilizing the Roth. So we did see a slight increase from a year ago. Distributions were up in comparison to 1 year ago. We had 21 distributions as opposed to 6, larger amounts. So, and some of that is a result of the force out of the small balance accounts as well. Okay. Loan activity is positive. No new loans during the first quarter, so those are just the repayments. And other activity is the net of asset transfers, dividends, fees, and revenue credit. So this was positive, and it was mainly due to the dividends. We had a larger amount in dividends compared to last year. And there was also a reversal of a transfer during Q1 2024. After the depreciation, the quarter end balance was 23.7 million, and the balance as of yesterday is about 25.4 million. Okay. Any questions?
Well, that's interesting. Does my Voya somewhere, when I go on the computer and look at, does it show me, like if I have 100 shares of A and they're worth $1,000 and I get $10 in dividend, does it show me that somewhere, that I got money from a dividend as opposed to my investment?
It should show you on your statement.
Okay,
Yep.
interesting. I'll have to take a look.
And the next slide. We did have 11 new accounts that were opened during the first quarter, and 10 participants that had a qualifying event and closed out their accounts, leaving a total of 446 participants. And again, as a reminder, that number represents both active and terminated employees. We had 132 terminated employees that have a balance in the plan, and 30 of them have a balance of less than $7,000. And then the chart right below that's just a breakdown of participation by age group.
Is the $7,000, is that our payout limit?
Yes.
All
That
payouts.
number increased with the Secure 2.0 legislation that went into effect last year. So it was previously 5,000,
5,000,
and it just moved up to 7.
And Charlotte, does the 30 with the account just not reflect the force out? Is that what be timing?
It may just be the timing. of
Okay.
it. Mhm.
Right, because that number will be 0 at some point in time.
Right. Right.
And then looking at the average account balance of 53,000, it's slightly higher than the benchmark, which is always good news. The average deferral rate for those that are contributing using a percentage at 6.9%, and which was slightly lower than 1 year ago. And then those that are contributing a dollar amount was higher than what we saw a year ago. And then the average new deferral amount for new enrollments, 6.6%, which I think is good.
Well, if you think about it, we contribute 7% to the state, right, for our retirement. So contributing another, it's still about 14%, of your, yeah.
Yep.
And then the average holdings, 2.3 compared to the benchmark. And then we did see a slight increase in the utilization of the managed accounts program. And typically, we see an increase when they're going through their enrollment experience for those individuals that would like additional assistance. And I know Pat will go through this as well. So this is, again, just a breakdown of the assets. Majority of the assets are in the target date funds, and that's where the majority of the contributions are being invested as well. So we had 71% are participants utilizing one fund. I'm sorry, 317, and of that 314 or 71% are using one of the target date funds. And looking at engagement continues to be strong. They're engaging with the call center, the mobile app, as well as participant website. We typically see majority of the participants prefer to use the participant website. And when we look down at the bottom of this chart, you'll see the breakdown by age group. And again, across the board, they're utilizing or engaging in all the different resources. And e-delivery and web registration continue to be very strong. The average replacement income is 45%, and we have 22% of the participants are on track to replace at least 70% of their retirement income. So, and then down below is just the replacement income based on how they're engaging with the tools. And here, a breakdown of number of participants that engaged with the various resources. When you look at the participant website, what we typically see is majority of those actions that are taken are related to the contribution, the deferral amount. And here, out of the 187 participants that engaged, there were 49 actions taken, and 67% were related to the deferral amount. And then the mobile app, same thing. Out of the 104 that used the app, 86% changed their deferral amount. So we did see a little bit more engagement with the My Orange Money tool, and we had 19 participants that engaged with one of the financial wellness tools, and 68% took action, which is good. So we just need more individuals, more participants utilizing the tools. And in addition to these resources, we have Marta that's on site on a regular basis. And during the first quarter, I think is a little bit slow, but she did engage with 32 participants during that time. She was been on site 4 times, and we're going to see a little bit more engagement. The numbers increase. It looks like April, May were busier. Okay. And then she'll continue to work with Catherine and team and just making sure that employees know about the benefit if they're not participating. She's worked with a couple different departments. She did mention to me that what she is seeing is that supervisors are taking a more active role and encouraging their employees to meet with her, which I thought was great. She's particularly pointed out the sheriff's office and make sure I get his name correct. Steve Hoff. Sheriff Hoff, yep. And he's done a phenomenal job during his meeting, just making sure. Mm-hmm. And that is it. Any questions? Oh, nice. Thank you.
Thank you so much. Next up is Mr. Patrick Wing with the first quarter performance report. Welcome.
Thank you, Mr. Weisskopf, and good afternoon, everyone. It's good to see you all again. So as far as today's discussion, I'll be a little briefer than typical. We do have Capital Group here online to talk about the target date series, to provide the board an update on the target date series we've talked about in the past. Given it comprises so much of the plan assets, it's important from a fiduciary perspective to hear from the proverbial horse's mouth on that. So with that, I'll try to keep things moving along here. So, but I could ask you to flip behind Exhibit 2 in the book and specifically go to page 13. As always, we'll just try to set the stage and provide some context for what happened in markets specifically, and provide a little context for how and why some of the managers within the plan performed the way they did. So again, page 13, at a pretty high level, and I'll just focus to the chart on the right from an asset class perspective. And it was pretty much the opposite of what we saw in Q4. So again, as a quick refresher, what we saw back then was U.S. equities posted a marginal gain, but pretty much every other major asset class listed here from top to bottom was either just marginally positive or in the red. But as you can see here for Q1 in these green bars, U.S. equities up top were comfortably in the red, whereas pretty much everything else was in the green, some marginally so and some predominantly so. If we look within the equity market from a regional perspective, so the top 3 rows, we did see developed non-U.S. and emerging market equities outperform U.S. equities quite handily. A lot of that was due to U.S. dollar weakness during Q1. So when we make investments abroad in stocks abroad, those companies generate earnings and cash flow in their local currencies. And when those local currencies appreciate relative to the US dollar, it means when we translate them back to dollars, they can buy more dollars. So we have more dollars in our pockets as US-based investors. So that was a nice kicker for developed non-US and emerging market equities in Q1. Fourth row down, US bonds. So that's a proxy for investment grade bonds there. Also a decent quarter, up around 3%. We saw interest rates come down notably across the Treasury curve, given the uncertainty around the economic outlook. Recall, this is a period in Q1 where we knew the tariffs were coming. We didn't know the level. We didn't know the timing, the magnitude, and the speed at which they were going to be implemented. And there was a lot of uncertainty around that, which caused rates to come down and bond prices to tick up there. And what was interesting within the bond market, if you look at the next 2 rows below U.S. bonds, which are, again, investment grade, bank loans and high yield are sub-investment grade bonds. So they actually lagged their investment grade counterparts, which is what you would expect when U.S. equities are under pressure. You can think of below investment grade bonds like bank loans and high yield, somewhat as a hybrid of core investment grade fixed income and equities from a risk perspective. But I mention all that because when we see later on, the active fixed income manager Baird, like all fixed income managers, will be underweight treasuries and have a little bit of an overweight to corporate bonds and a little bit more towards areas that carry a higher credit risk. So that led to slight underperformance from Baird. Further down the page there, about 4 up from the bottom, you can see TIPS, or Treasury Inflation Protected Securities. They posted a very strong gain north of 4%, well ahead of investment grade bonds. Again, in the wake of potential tariffs, we saw inflation expectations tick up rather notably, which led to very strong returns from TIPS on an absolute and relative perspective. Now, if we can go to page 14, this is probably the most important one from a market environment perspective. It gets into some of the equity dynamics within the U.S. market, and then we can relay this and use it for context when we get into the individual manager names here in just a minute. But when you look up top from a sector perspective, it was largely similar from a broad asset class perspective. In other words, it was pretty much the opposite of what we saw in Q4. So again, in Q4, U.S. equities posted a marginal gain, but most sectors were actually negative. So that meant the largest sectors comprised of the larger stocks did well and carried the broad market into a gain. But here in Q4, the majority of the sectors, which are the lighter bars, were actually positive. 6 of 11 were positive, but the broad market was down handily because those same larger sectors, your communication services up top, your consumer discretionary right after that, and then 4 up from the bottom, your information technology, were the worst performers, right? So here's your magnificent 7 stocks, right? Your Amazons, your Teslas, Apples, Nvidias, et cetera, et cetera. And why that's important from an active management perspective in the large cap space, particularly the growth spaces, active managers are typically underweight the largest stocks in their given benchmark. So being underweight stocks that underperformed in Q1 here was helpful from a relative basis. And relatedly, we don't talk about it on this page, but in other areas of the U.S. equity market, particularly in small and mid cap area, more speculative type names, more volatile names, those related to, say, AI, crypto, or quantum computing were also under some heavy pressure in Q1, and the managers in the small and mid cap area are generally underweight those names. So when we see the active manager performance here in just a couple of minutes, most active U.S. equity managers outperform their respective benchmarks in a difficult market environment, which is what we would expect because they're generally underweight more volatile speculative names that underperformed in a down market. The other quick thing I'd mention is that what we saw within U.S. equities is given the underperformance of these large mega cap sort of growth related names is that value stocks outperformed growth stocks quite handily. And that will influence the target date series returns across that spectrum, right? We've talked about repeatedly how those earlier funds or in retirement or close to retirement have more of an overweight to value stocks given they pay income. They tend to do better when inflation is rising. They have lower volatility. And then as you go across the spectrum and get further and further out, they have more allocated to growth stocks with the idea that in the hopes of more capital appreciation, younger participants can tolerate the volatility. So I hope I didn't scoop Capital Group too much there, and they'll speak to more of that in just a couple of minutes. But we'll see that in the data here shortly. So with all that said, if I can ask you to flip over the next exhibit, just talk a couple of quick things before we get into the manager performance themselves. So on page 22, and this is largely around some of the comments I made already, but just to see it in print, the plan assets at the end of March, right in line with what Sarla had mentioned earlier. As she noted, they're quite a bit higher today. What we've seen from a market perspective in Q2 is not just have the asset classes that did well in Q1, save bonds, which I believe are flattish during the quarter here, but the equity markets continue to grind higher outside the U.S., and the U.S. has rebounded quite handily and is now firmly in the green year to date. So a pretty strong quarter for U.S. equities and driving the increase in plan assets that Sarla referenced. The target date funds, again, comprise almost 70% of the plan assets, again, just echoing the importance of having Capital Group come in and speak to them. From an active equity manager performance perspective, as I noted earlier, most of them outperform their respective benchmark given their processes in a difficult environment. Again, we would expect that. The fixed income side, as I noted earlier, Baird was slightly behind the benchmark because bonds, sort of investment grade corporate bonds and lower quality bonds did underperform treasuries. And then the other manager, PIMCO, there on the international bond side actually topped its benchmark. So a little bit of a split case there within fixed income. And then as far as the target date funds, I've really already commented on that first bullet point, but it's also important, and we'll see this in the data in a minute, that the longer term results remain exceptionally strong across the series, regardless of whether we're looking at, funds in or close to retirement or ones way out in 2060, 2065, et cetera. Those funds have done very, very well over the long term. So as far as page 23, if I could draw your attention there, you can see the growth of the plan assets over the past 5 years or so. And going back to about 5 years ago, all the way to the left, and then a brief dip, if you will, in the first couple quarters, plan assets have, called approximately doubled, maybe not quite that much, but close to doubling over the past 5 years or so. So obviously that's a function of a couple things. So obviously it's been good markets, particularly within equities, over that period, but also, as Sarla spoke to earlier, the cash flow profile this most recent quarter, notwithstanding with the force out, has been generally positive too. So that's been an additional kicker for the plan assets increasing over time. And then on the next page, just to show you a little bit of a breakdown, and I'll just really focus across the asset classes or the lighter gray rows here. It's always interesting to see how that's changed from quarter to quarter. So if I could focus your attention all the way to the right there, under percent of portfolio, the changes were certainly in line with market conditions. And what I mean by that is for U.S. equities, you can see they comprise a little more than 17% of plan assets. At the end of last year, that was just a shade under 18%, so that did come down. Again, not surprising since U.S. equities were the worst performing asset class. And then in turn, what makes sense, if U.S. equities came down and they were the worst performers, areas that did better ticked up a little bit. So you go to non-U.S. equities, the next darker row, they're a small part of the plan assets, but they jumped up from 1.9% to 2.2%. So that on a percentage basis, that's a pretty sizable increase, about 16% of an increase from a dollar perspective. Fixed income, similarly, again, it was a pretty good performing asset class, so that moved up to 11.8% from 11.5. And then finally, the target date funds allocation was relatively static at just a shade under 70%. So again, not just U.S. equities underlying those target date funds, but diversification as well into some of those other asset classes that we showed on page 13 that did well during the quarter. So the change in the respective allocation certainly makes sense and is intuitive based on what we saw amid the markets in Q1. So with that said, we go to page 26 just to highlight some of the individual investment options for the participants here. And we'll focus on that 3-month column. Again, that'll be synonymous with Q1. And starting up at the top, Vanguard Equity Income, which is, again, one of the newer names within the plan, if the board recalls. It was approved to replace JP Morgan Equity Income late last year, so they had a good Q1, again, in a difficult environment more broadly, but benefiting from some decent stock selection and then having an underweight to that information technology sector. That was one of the worst performers, was helpful for them on an absolute and relative basis. We skip over the Fidelity 500 index, which was in line with the benchmark as we would expect. The Fidelity Contra Fund, that's the large cap growth manager. It was down 4.5%, but a pretty strong quarter relative to the benchmark. So I talked earlier about the dynamics of these largest mega cap stocks really having an overt influence on the broader market. Well, they are all large cap growth names in that benchmark. So think about them influencing the broad market. Their influence on this benchmark is even greater. They comprise even more or bigger portion of this benchmark. So not just whether you're underweight them, which was helpful for Fidelity during the quarter, being underweight them since they underperformed, but what we did see was amongst those 7 or 8 names, rather decent dispersion of performance. So not just underweight in aggregate, but who specifically you were underweight. And more specifically, Fidelity was underweight both Tesla and Apple in Q1, and that was very helpful for their returns on a relative basis. As we continue to work our way down that page, really focusing on the active managers, you see Allspring there, the mid-cap value active, was pretty much in line with the benchmark, so not too much to speak of there. We go down a couple rows, MassMutual, the mid-cap growth manager, was the lone U.S. equity name to underperform its respective benchmark. Had some stock selection issues during the quarter in the healthcare and information technology sectors. It was a little bit of a headwind for them. But per my comments earlier, both names in the small cap space, so that's Allspring in small value, and then Wasatch all the way down at the bottom there, the core growth fund, both have more higher quality bents to them, so they would be underweight those names I spoke to earlier, right? The AI, crypto, speculative names that got hammered in Q1. So like I've spoke to before, avoiding the losers, if you will, is almost, if not just as important in a down market than picking the winner. So their processes led them to be underweight those respective names, and even though they were down, they were comfortably ahead of their respective benchmarks. And for the non-U.S. equity on page 27, a little bit of a mix here. DFA up top, they were about 3 percentage points behind their benchmark. You know, if you recall when we did a search in this area, one of the hallmarks of the strategy is having a decent allocation of small cap names within international markets, and small caps lagged in Q1, so being overweight an area that lagged the broad market, even though they posted a very high absolute return, led them to underperforming. And then in the middle there, you see the broad index, the iShares MSCI EAFE that was added late last year, and then America Funds Euro Pacific Growth was also marginally ahead of its benchmark by about 60 basis points as well. So when we think about the U.S. and non-U.S. equities in aggregate, you know, about 8 of 10 or so active managers were ahead in the difficult environment. So a pretty decent quarter, at least on a relative basis in markets, particularly in the U.S. that were rather challenging. And then as far as fixed income down below, again, you start with the Vanguard Total Bond Market Index, so in line with its benchmark as you would expect. And then the next two are the active funds I talked about earlier. So number one, Baird, who's also a newer name there, a little bit behind the benchmark again because it will be underweight treasury bonds, have a higher allocation to corporate bonds, and the latter underperformed treasury. So that drove some slight underperformance. But offsetting that was PIMCO, the international active manager, was about 40 basis points ahead of its benchmark, slightly positive return compared to the slightly negative return for the benchmark, and really driven by its positioning across the various yield curves in non-U.S. markets. So, for instance, long-term yields actually rose in Europe, and they were underweight long-term bonds in Europe. So just an example of them getting their positioning right on where interest rates were headed across the globe was helpful for them during the quarter. And then finally, and I won't speak to this all that much, save it for Capital Group who's jumping on, but if you go on page 28 and you work your way from top to bottom there, this just illustrates my comments from earlier, specifically that the funds in or close to retirement, starting with 2010, kind of going to 2030, very much in the green, strong absolute and relative performance. But then as you work your way further down the page, you can see it mildly flip to red. And then when you go to page 29, a continuation of that. And I suspect, but they'll, I'm sure, confirm in a minute here, again, that's really the value growth continuum, right? So value stocks outperform growth stocks, or even vice versa, by double digits in one quarter. You'll likely see a dynamic of this across the series. But all that said, again, if you look all the way to the right, really on 29 or on 28, pretty much green up and down across the board. And those numbers in parentheses right above the gray rows are the ranking within the target date universe. Again, lower numbers being better there. So it really exceptional absolute relative returns compared to the benchmark and the peer group. So I probably set them up pretty good there for them to come on. But, you know, I think it's kind of easy to come on and give an update when you post results like this. So with all that said, that wraps up my prepared comments. Happy to answer any questions before we shift gears and bring them on.
I'm good.
Okay.
Thank you, Mr. Wing.
Could we have a motion?
Yes, we do need that.
Thank you.
Is it a motion to accept the
Report.
reports? I move to accept the reports provided.
I second.
I have a first and a second. All those in favor signify by saying aye.
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 Ayes have it. Motion carries. Thank you, Mr. Wing.
Thank you.
Next up is our friend that is online, or two friends that are online, forgive me, from American Funds Target Date Portfolio Review. Welcome.
Thank you. Good afternoon. Sorry I couldn't be there in person again this time, but we'll save it for another trip. Want to thank the board for this opportunity to speak to you about the American Funds Target Date Series. I'm here with my colleague Rich Lang, who will cover the series. I just wanted to come on and thank you for this opportunity and for trusting us with your assets. I did have an opportunity to speak with Pat prior to the meeting, so we have, my understanding, 20-25 minutes to cover the series. I just wanted to remind the committee that Rich will describe why we're so passionate about what we do about investing, and we believe that our mission is to improve lives through successful investing. And so the rigor around the glide path, the committees that manage this pool of capital is constantly at work. So with that, Rich, I'll hand it over to you. I think you would want to give us to share your presentation.
Yeah, let me share my screen. Hopefully you all see it. How did I call it up? This over here. So yeah, it's exciting to hear, and thanks for your trust. 70%, I think, of your plan assets are in the target date series. 100% of my retirement are in the target date series, so I do use it as well for my retirement. And what we're trying to solve for your participants, who many of them might be defaulting into this investment, is we're trying to balance those objectives of building and preserving wealth. I like to say it's easy to do one or the other. It's difficult to do both. So we do provide meaningful equity, particularly as you approach retirement, more equity than the average target date series. But we make strategic changes to the glide path, which allows us to have more equity with a lower volatility profile. So our strategic approach and then also the active management of our underlying strategies allows us to address both of those, I would say, competing objectives. Let me go to slide 12 here that highlights the key points of the series. Dates back now over 18 years to February of 2007. We're today approaching close to $400 billion in target date assets, which makes us one of the fastest growing target date series in the industry. It does get recognized by Morningstar with a gold rating, which is the highest rating they have for target date managers. We talked about building and preserving wealth for your participants. We build wealth by having meaningful equity exposure across the glide path. We rely on global diversification and then our ability as an active manager to provide meaningful excess above index investing. And then how do we preserve wealth? Like all target date providers, we do reduce the equity allocation as participants get closer to retirement, but we do move to more dividend-focused equities that historically have been less volatile when the market sells off. Then we rely on our fixed income to offset equity volatility. And then our active management helps on the downside as well, with every one of our equity strategies over its lifetime having a downside capture ratio below 100%. So what that means is when equity markets sell off, our underlying strategies preserve better historically than their broad markets. The design principles, we talk about changing the types of equities. That's our glide path within a glide path. We will use global equity strategies in our series as well as balanced strategies. We feel it's difficult to make top-down tactical allocations, so we rely on the managers and the underlying strategies to tilt the series appropriately, either U.S., non-U.S., or stocks and bonds. And then our series is managed 30 years through retirement. At age 65, we feel participants are still long-term investors. They need meaningful equity, but the amount and types of that equity should continue to change in retirement. Here's the committee that oversees the target date series. So no change over the last year. This is a combination of 4 dedicated solutions managers. So you have Michelle Black, Samir Mathur, Raj Paramaguru, and Wesley Foy. 100% of their time is dedicated to the target date series. And they're joined by 4 strategy managers. David Hogue and Shannon Ward manage on some of the fixed income strategies. And Will Robbins and Jessica Spaulding are equity managers. So we think this combination is important. It allows, those dedicated managers to get insights and views from those strategy managers who understand what's happening real time with, the fixed income markets and the equity markets in those particular funds that are part of the series. You do see they average about 30 years of investment experience, and they also invest meaningfully in the target date series. So not just associates here at Capital, but the people managing the series are aligned with the participants in your plan as well. Now, here we look at this objective-based glide path. So, you think of your participants at a high level, they need appreciation, income, and preservation. So our underlying funds have been managed to those objectives for over 90 years. So when we constructed our glide path, we selected those funds, for younger participants, which funds are more appreciation or growth focused. And then as you get closer to retirement, you can see the blue shaded area represents our equity funds, more of that dividend focus. So as participants get closer to retirement, they're going to have that higher dividend income yield. And as I mentioned, the reason we do that is historically, and we've seen that over the lifetime of the series, that has provided greater resiliency when the broad equity market sells off. And then you can see the fixed income objectives, 4 distinct objectives we're trying to solve for. Further from retirement, we want our bond funds to offset equity volatility. As you get closer to retirement, it's a broadly diversified fixed income portfolio. We do add some inflation protection to protect them against short-term inflationary spikes. And then in the distribution period, you can see it's really a focus on capital preservation, short maturity, high quality fixed income. This illustration shows the different strategies we use at various points So I mentioned the global strategies, which is a bit of a differentiator in the industry. Most providers are going to be a bit more asset class pure. You can see Small Cap World Fund, our global small cap fund, a meaningful 10% allocation. New Perspective is a global growth fund as well, at 10%. And then the equity income and balance funds that'll have both stocks and bonds. You can see we use those meaningfully kind of in that distribution and transition period as participants begin to focus a bit more on income and preservation. So given this approach, I like to say we view asset classes as really a means to achieve the objectives we're trying to solve for in our series. Other providers will be maybe a bit more focused on a specific asset class and almost view that as the end. So, given this approach, you're going to get the broad diversification across asset classes, but we don't have a strategy dedicated to REITs. You see a small allocation here to REITs. We'll get that from our equity income funds. So given this asset class flexibility, it's incredibly important to monitor those ranges of some of those asset classes. So what I'm sharing here looks at the geographic flexibility in the upper right-hand corner. So over the lifetime of the series, the gray shaded area shows what the non-US equity range has been. And over the last, I would say 10 to 12 years, we've been at the lower end of that range. And for that majority of that time period, really for the last 10, 12 years, US equities have outpaced non-US by well over 2 to 1. So it's been additive to have more of a US focus than peers. You can see the average for our series is about 35% in those further dated vintages. What's been interesting is, the last 18 months or so, we actually have been net sellers of US equities, but prior to this year, US equities in 2024 were up 25%. Non-US was up only 5%. So you haven't really seen that reflected in the overall allocation. Now you fast forward to this year and you actually have seen non-US markets outpace quite meaningfully. So it's been a bit more of a headwind for us because we do have a bit less non-US exposure than peers, but I do anticipate that coming off the bottom as we move forward. Let's look at the results of the series. And this is the one illustration I think I would want you to kind of leave with when if your participants ask, why are we in the American Funds Target Date Series? We talked about building and preserving wealth. This illustration shows the 10-year upside capture ratio and the 10-year downside capture ratio against the broad S&P Target Date Index. And you'll notice when the S&P Target Date Index is positive, we've been able to generate as much or more on the upside. And when the index is negative, we've been able to preserve better on the downside. And we continue to be the only provider in the industry with this profile, every vintage at or above 100 on the upside, and then at or below 100 on the downside. So I think it's a good proof point that through our strategic design, the active management, we've been able to deliver on this difficult profile of returns, the fact being we're the only provider to do that. If we look at results, as Patrick pointed out earlier, you could see as of the end of the first quarter, the fact that we do have more growth equity in those further dated vintages. You saw quite a big difference between growth and value. I think it was about 1,200 basis points over the first quarter where growth lagged the value, more dividend-focused portion of the market. So that was a bit more of a headwind for that quarter period. You do see those near retirement vintages doing quite well because they had a bit of that greater allocation to dividend-paying equities, which held up quite well in that first quarter. Also, a bit of a headwind over the quarter was the strength of the non-US markets, as I mentioned. I will point out the 5-year results. You do see some softer relative results there over the last 5-year period. We did roll off a very strong first quarter of 2020, which was the quick COVID bear market period where the series held up well. In those further dated vintages, we actually have slightly less equity than peers. We're about 89% equity, while the peer average is closer to 93%. And interesting, over this 5-year period, you actually had negative returns from bonds, and the S&P 500 was up about 18%. So a pretty big difference there between stocks and bonds. I do anticipate having a bit more of a tailwind as we roll off the third and fourth quarter of 2020 as we move through the rest of this year, as those were kind of difficult quarter environments for us. So we should see, and actually, as I jump here, let's see, not this one, you can see actually results year to date through Tuesday of this week. So you have seen significant improvement in kind of those year to date ranks of those further dated vintages. So what's been interesting, you've seen, it's almost been a tale of two quarters. In the second quarter, you now seen growth significantly outpace value, 15 to 3%. So that has favored those further dated vintages, and you've seen significant improvement there. Continue to see non-U.S. markets year to date up 16%, the S&P 500 up 4%. So continue to see non-U.S. markets lead, and then you have seen improvements in those 5-year numbers as well. And then those 10-year ranks continue to be, industry leading. And I think, it's important. We always want, as time period dependent, those results to be as strong as possible. You've seen that, pretty consistently. But what we really do focus on is the ability to continue to generate these types of results. So what we show here is on a rolling 10-year basis. We have 98 rolling 10-year periods. 95% of the time we've been able to generate top quartile returns. And then on a risk-adjusted basis, Sharpe ratio, we've been able to deliver top quartile risk-adjusted results 98% of the time over those 10-year periods. And that's really what we're focusing on, is full market cycle success for participants, because they're in this investment for potentially 60, 70 years. So I'll stop there and see if you guys have any questions.
Pretty fabulous.
Yeah. Can I?
Impressive.
Is it okay if I ask one? Just quickly, Rich, David mentioned earlier, you guys are constantly evaluating the series, the glide path, the composition of everything within the glide path. Anything you're kind of ruminating on these days about potential changes or maybe broader topics that you're thinking about, understanding that you may not be able to tell me what you that you're thinking about changing? But what's the committee thinking about these days, and what might come of that, those conversations, if anything?
Yeah, no, I'm happy to tell you what we're working on. We may not implement, because a lot of times, the research may not lead to changes. I will mention in 2024, we did make a slight adjustment to the series. We did add I would say a marginal allocation here to our emerging market bond fund in those further dated vintages, a 1% allocation. And we did increase exposure to our New World Fund, which is our global emerging market fund in those further dated vintages. We're finding, emerging market equity and debt relatively attractive compared to the developed non-U.S. and the U.S. markets. So we felt having a bit more exposure there would help those younger participants with their appreciation objectives. Current things we're looking at now is, if you look at 2022, you did see a significant rise in inflation and in interest rates. And in that environment, inflation-linked bonds, TIPS, did not provide the protection we would have hoped. A lot of that was just due to the duration exposure. So we're evaluating ways to protect participants against inflationary spikes in additional ways than just a dedicated TIPS allocation. So some of that initial research has shown, the dividend paying area of the equity markets historically have been a good hedge against inflation. And, does it make sense? As you kind of see here in our glide path, we already do move to a bit more of a dividend focus for those older participants. So looking at additional ways to hedge against short-term inflationary spikes. And then we do have two strategies we're evaluating. We have a U.S. mid-cap offering, and then we have an international bond hedged portfolio to see, if there are potentials there for inclusion into the series, and what would be the benefits for participants beyond just diversification, and how would it align with those objectives. So no changes have been determined yet, but if we do make changes, it would probably be in the fourth quarter of this year, and we would communicate that prior to implementation.
Thank you, Rich.
All right, thank you and good day. What's next?
Thank you.
Thank you.
Thanks,
very
everyone.
much.
Have a good day.
Thank you,
Bye.
guys.
Thanks.
Yeah.
How much money would they have to manage of ours for them to leave their screens on while they're presenting?
Oh,
They had their screens on. Not David, but the fellow that was presenting.
Yeah, the fellow presenting did. David didn't. I just find it rude. Maybe it's just me. I apologize, but if you can't have your screen on for a 20-minute meeting, whatever. They don't have any of my money. All right. Next up is the administrator's report.
Thank you. We a couple of invoices paid. We paid Marquette Associates for the first quarter of 2025. Management fees of $4,500. And then we paid a fiduciary insurance policy renewal to RCMD of $6,725 for a total amount of $11,225. And then the next meeting of the Governance Committee is September 25th, 2025.
Okay.
And if we could have a motion?
I move to approve the administrator's report for June 26, 2025.
I second.
I have a first and a second. All those in favor signify by saying aye.
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 Ayes have it. Motion carries. One last,
I move to adjourn, please.
Second.
I have a first and a second. All in favor signify by saying aye. Aye. Meeting adjourned. Thank you.
Thank you.